Everyone loves to talk about stocks that already took off, but few stop to ask why they went up and whether there's still fuel in the tank. While the market was obsessing over AI and interest rates, two forgotten names, FuboTV and Groupon, quietly exploded in 2025. Tripled, doubled in just a few months. But now what? Was it luck? Or is there still a real thesis here? One that could double again? In this video, I'm not here to sell you hype. I'm here to show you the facts. What changed in their business, why they went vertical, and what could happen next. Because if you know how to do the math, this might still be cheap. Don't forget to like and subscribe to receive more content like this. Well, the first stock that can double again in 2025 is FuboTV. FuboTV was basically written off. In January, it was trading below $2, burning cash, losing market share, struggling to scale, and then Disney walked in. In one of the boldest moves of the year, Disney announced it would merge its Hulu plus live TV business with FuboTV, taking a 70% stake in the new entity. But this wasn't just a handshake. They backed the deal with $220 million in cash, a $145 million loan, and a $130 million termination fee if the deal collapses. Why? Because this isn't about streaming movies. It's about owning the future of live sports. Fubo has always branded itself as a sports-first platform. Now, with Disney and ESPN behind it, that tagline actually means something. Post-merger, they're projected to have 6.2 million subscribers. That puts them on a whole new level of bargaining power with content providers, with advertisers, with everyone. But don't get too excited just yet. The deal still needs to be approved by regulators. And even if it is, Fubo has to prove it can do something it hasn't done before: make money. Their licensing costs have historically eaten up 80% of revenue. Profitability is still a big question mark. But here's the upside. If this deal goes through, and if Fubo executes, this isn't just a rebound story. It's a total reinvention, from a penny stock to a front row seat in the streaming war. And that's why some investors believe the rally isn't over. Now, the second stock is Groupon. Do you remember Groupon? That site everyone used in the 2010s to get half-off massages and sushi? Yeah, most people assumed it was dead. Revenue had been falling for years. The business looked outdated, and the stock had collapsed. But 2025 flipped the script. In the first quarter, Groupon surprised everyone by posting a profitable quarter, something the market hadn't seen in a long time. The result? The stock more than doubled in a matter of weeks. But here's what really matters. Analysts are now projecting revenue growth for the first time in years, not just in 2025, but accelerating into 2026. How? By doubling down on what made Groupon work in the first place: local experiences, restaurants, events, things to do near you. In a world where people are cutting back, small businesses need ways to attract customers, and Groupon is still one of the cheapest, most scalable ways to do that. It's not flashy, it's not tech 2.0, but it's cash efficient, asset light, and highly local, and that gives it resilience. Now, to be clear, this is still a risky play. The company's long-term brand damage is real. They'll have to fight to win back both users and merchants, and any macro slowdown could hit them hard. But that's also why the upside is so big. But just a moment for my usual disclaimer. This video is not an investment recommendation. You should not invest in these assets without a lot of clarity and a good thesis behind it, and I am not trying to convince you of that. It is just educational content, okay? So, can they really double again? Let's do a full recap of both. FuboTV is trading around 3.65 right now. If the Disney deal closes and the market values the new Fubo at just 2 times revenue with a projected $2 billion in combined annual revenue, that's a $4 billion valuation. Fubo's market cap today, around $1.3 billion. That means, yes, there's room to double, but only if the deal goes through, they stop bleeding cash, and the market believes in the synergy. And Groupon, they're trading around $36. Earlier this year, they were under $10, a gain of nearly 270%. What changed? They flipped to profitability, and analysts expect a stabilization in revenue, maybe even growth in local billings. But here's the catch. Even if they get back to $1 billion in revenue and the market values them at a 1.5x sales multiple, that's a $1.5 billion company. Groupon's market cap right now already around $1.8 billion, so that double might already be priced in. But here's the real insight. These aren't just hype trades, they're optionalities, asymmetric bets, the kind of setup where you risk 1 to make 3 if the thesis plays out. So you don't need to go all in. You just need to size the position based on the probability of success. Because in investing, it's not about being right every time, it's about being right big when it actually matters. Well, that's it, cousins. Stay invested.